Hi guys, welcome back to Father and Son Investing. Today's video is a September update for Treasury notes and Treasury bonds. I already did the Treasury bill update earlier, and that's really kind of a separate category, so I'd encourage you to go ahead and watch that video as well. Today we'll be talking about three things that I think will be keeping Treasury notes and Treasury bond yields up during the month of September. Of course, when they say yields are up, that means prices are down. That is the bottom line up front for one of the viewers who wanted me to get to the point quickly. So here are the three things that I will tell you about, and then we'll explore those in detail. The first one has to do with the amount of corporate bonds being issued during the month of September. Item number two will be the U.S. debt issuance going on in September as well as the next few months, as well as the amount of debt that the U.S. has to repay over the next 12 months. And finally, we're going to talk about inflation expectations. I will give you what I think is going to be happening with inflation, courtesy of the Cleveland Fed website. So those are the three things bottom line up front. Item number one, corporate bond issuance. You may have noticed yesterday that the yield on U.S. Treasuries went up. There was a couple of reasons that were speculated for that. One certainly had to do with oil prices and the fact that the Saudis and the Russians are going to extend that period of time when they keep their oil production low. But the other thing that was affecting U.S. Treasury yields yesterday was corporate bond issuance. There was $36 billion worth of high-grade corporate bonds issued yesterday, and they were surprisingly issued at a rate of 5.7%. So that is currently above what the U.S. Treasuries are issuing, and people were selling out of U.S. Treasuries, moving over to corporate bonds, which of course drove the U.S. Treasury yields up. This right here from Bloomberg gives you an idea of just how much the corporate bond issuance has gone up. Compare June, July, and August, and you'll see that it's up significantly. They're estimating $120 billion worth of corporate bonds, high-grade corporate bonds, will be selling during the month of September. And it may go as high as $150 billion. Most of that issuance is going to occur this week or really next week before the CPI, the Consumer Price Index, comes out, and before the Fed meeting, because these bond issuers are trying to get ahead of any economic news. So expect that these corporate bonds being issued, many of them at rates higher than what you can currently get with a U.S. Treasury, expect that that's going to continue to help keep U.S. Treasury yields up. So that's item number one, corporate bond issue in the month of September. Let's move on to item number two, and that is the U.S. debt issuance. The U.S. Treasury recently announced that it will be increasing the issuance for both the Treasury notes from 2 years to 10 years and for their Treasury bonds. Those are the 20-year and 30-year bonds. That started actually in August. Just how much are we talking about? First of all, we'll be using July as the benchmark, July of this year. In July, there was $246 billion worth of notes and bonds sold by the U.S. Treasury. So looking for September and really October, we're going to get a feel of just how much these are going to increase. In September, the Treasury will increase its issuance of notes and bonds by $24 billion up to $270 billion. In October, they're going to be increasing it by $35 billion over that July benchmark to $281 billion. So with an extra $24 billion in September and an extra $35 billion worth of notes and bonds in October, there needs to be a buyer for all of this extra issuance. And one way to get the buyers in is to keep the yields up. Now, not only will the issuance of U.S. Treasury notes and bonds go up in September and October, but there is a good chance that it will continue to go up over the next 12 months. In a scenario that they call the neutral issuance scenario, the Treasury Borrowing Advisory Committee says this: Treasury should jack up its monthly issuance of 7 main notes and bonds by nearly 60% over the next year to $354 billion in August of 2024. That is a huge increase, and this is what it looks like graphically. The Treasury is shifting towards longer notes and bonds. Earlier this summer, when they needed to fill up their coffers again, they issued a huge amount of Treasury bills. And of course, Treasury bills are only up to 52 weeks. So there will be a very large sum of Treasury bills that are going to come due in the next 12 months. We see this graphically here, this line here in green. You can get an idea of how much U.S. public debt is maturing within 1 year or less. Look at how this has just skyrocketed. All of that debt maturing potentially will get resold in the notes and bonds category. So that's one more thing that could help keep the yields up on Treasury notes and bonds. Item number 3, inflation. If you have been paying attention to any of the recent headlines, you may have seen things like this. Diesel fuel has been up 40% over the last few months. And of course, I mentioned that yesterday the Russians and the Saudis announced that they're going to keep their oil production at decreased levels until December. That drove crude prices up yesterday. Of course, when people are paying more for diesel and gas, that's going to increase the price of the products that we buy every day. Let's get a peek at what inflation might look like when the CPI numbers come out next week. This is from the Cleveland Fed. It's called their nowcasting site. If you've never looked at this, it's kind of an interesting thing to keep an eye on if you want to get some expectations for inflation. They're not perfect. Occasionally they miss significantly. Let's get a peek at what they say the August inflation numbers are going to come out as. They're saying 0.79 month over month. And the core CPI 0.38. Remember, the difference between these two is gas or oil costs and food costs. So you can see that that's going to make up a huge difference there. 0.79 is an incredibly hot number month over month. Right now they're saying for September, it's very early in September, and so we don't have a lot of data, but they're saying 0.38 month over month. And when we look at the year-over-year numbers, those do look a little better, at least. They're saying for August it's going to be 3.8%, but that would still be an increase over what July was and an increase over June. So inflation heading the wrong direction if the Cleveland Fed's estimate comes in correct. And they're saying for September, 3.84 year over year, so potentially even ticking up just a little bit more inflation for September. Now, what is that going to do when it comes to the Fed's policy-making decisions? It might not change the policy for September. Most of the experts are predicting that the Fed will not increase rates for September. Let's just turn to the CME Fed Watch website. You'll see that for September, they're predicting 91% chance that the Fed does not raise rates. But if we click on November, you'll see that it's kind of a 50-50 game there as to whether the Fed will raise rates or not. Let's wrap up this video by just getting a quick peek at where the 2-year note to 30-year bond prices are falling today. And we'll see that actually the 2-year note has gone up significantly. I actually bought my first Treasury note last week. I got it at 5%. The yields now are over 5% just by a little bit. And we'll see really that even everything except for that 30-year bond, the yields have gone up, meaning the prices have gone down. If any of this was helpful for you, please give us a thumbs up, and we'd love to have you subscribe. Always, always, always share this kind of information with young people in your life. These are really great tools right now for people to get started in investing, get a win by getting some nice returns. Until next time, enjoy your investing.